Hello everyone. Today I want to tell you a story about the shifting of cash flows, a story that is happening right now in the United States but directly affects our wallets anywhere in the world. This is not about dry numbers on an electronic board, but a story about the battle between the old and the new and how banking giants are quietly making a move that many are calling an act of genius. To begin, I want you to imagine a beautiful day when you want to send a large sum of money to a relative abroad. In the traditional way, you have to go to the bank, fill out tons of paperwork, wait for several days, and bear a not-so-small fee. That is how the world has operated for hundreds of years. Then, cryptocurrency appeared, like a cowboy in the Wild West. It was fast, cheap, and uncontrolled, but it was also full of risks. You could send money in a heartbeat, but you also lived in fear of the exchange collapsing or the coin you held suddenly losing its value. In that world, there is something called a stablecoin. It is like a bridge. It is virtual currency, but its value is pegged to the US dollar. Companies like Tether or Circle have ruled this space for years. Traditional banks looked at it with eyes that were both disdainful and envious. They were disdainful because they thought it lacked safety, but envious because of its speed and convenience. And this is where the story becomes interesting. Recently, there has been a new wave, a bill, or rather a strategy that people compared to a genius move by the US banking system. The story starts with a simple but bold idea. Why don't banks issue their own stablecoins? I will explain this part a bit more carefully for you to visualize. Previously, US banks were very afraid of cryptocurrencies. They feared money laundering risks and fines. But they realized that if they stayed on the sidelines, they would gradually lose market share to financial technology companies. Therefore, lawmakers and banks are shaking hands to create a new playing field. A new act, often referred to as Lummis Gillibrand or similar variations, is paving the way for this. The key point, or the genius here, lies in 4 letters: FDIC, specifically the Federal Deposit Insurance Corporation of the US. When you deposit money into a US bank, if that bank goes bankrupt, the FDIC will compensate you for an amount up to $250,000. This is the strongest shield that creates trust in the banking system. So what happens if banks issue stablecoins and these coins are treated as a deposit? Imagine it like this. You have $100. Instead of keeping it in a normal bank account, you exchange it for 100 digital coins issued by that bank. You can send this digital currency around the world in seconds on a blockchain platform. But, and this is the most important but, those 100 digital coins are still considered a deposit at the bank. That means if the bank collapses or there is an incident, that money can theoretically be insured. I call this a genius move because it solves the biggest pain point of crypto users, which is trust. Currently, when you hold Tether's USDT or Circle's USDC, you are placing your trust in that company. You trust that they really have enough dollars in the vault to pay you back. But what if one fine day they disappear? No one dares to be 100% sure. But with banks, with government backing and clear regulations, that trust is much more solid. Let me give you a specific example to make it easier to understand. Think of 2 storage shops. The first shop belongs to a private guy. He promises to keep your things carefully. His warehouse is big and nice, but no one checks him regularly. Those are the current stablecoin issuing companies. The second shop belongs to the state, or is specially licensed by the state, has 24/7 surveillance cameras, and if things are lost, the government will pay you back. That is the model of bank-issued stablecoins. When US banks are allowed to do this, they will flip the table. They do not need to compete on technology with crypto companies, because technology can be bought or copied. They compete on safety and legality. This is a heavy blow to current stablecoin companies. Why would you risk keeping money in a private company that is uninsured when you can hold digital currency from a major bank like JP Morgan or Bank of America as convenient as crypto and as safe as a savings deposit?
But the story does not stop at safety. It is also about control. When banks issue digital currency, they can integrate it deeply into the existing financial system. You can use that digital currency to pay electricity and water bills, buy groceries at the supermarket, or even pay taxes smoothly. It blurs the line between money in an e-wallet and money in a bank account. I want to analyze the technical aspect a bit deeper, but in the simplest way. When a bank issues stable money, essentially they are tokenizing your deposits. Previously, the money in your account was just a number in that bank's own database. Bank A could not see Bank B's database. To transfer money, they had to message back and forth through intermediaries, taking time and fees. But when that money is tokenized on the blockchain, it's like taking cash out of your wallet. You can give that bill to anyone, and any bank will recognize it immediately without complex book reconciliation. That is the power of technology that banks want to leverage. However, nothing is perfect. In this story, there are also dark sides that I need to mention so you have a multi-dimensional view. When banks and the government control stablecoins, it means they completely control your cash flow. One of the reasons people loved crypto initially was freedom and anonymity. But with bank stablecoins, every transaction of yours will be recorded and closely monitored. They know what you buy, who you send money to, and at what time. Privacy will be traded for convenience and safety. Furthermore, big banks participating in this game could lead to a monopoly. Small startups and creative crypto projects could be suffocated by strict regulations that only big banks are strong enough to comply with. We might see a familiar scenario: big fish eating little fish, and eventually power concentrates in the hands of a few giants on Wall Street. I also want to add about its impact on the global financial market. When the US does this, the dollar will become even stronger in cyberspace. Currently, other countries are trying to reduce dependence on the dollar. But if there is a safe, insured, and instant-moving digital dollar, the whole world will flock to use it again. This reinforces the US position, but also puts pressure on the currencies of other countries. Let's go back to the story of ordinary users like us. What does this event mean? It means that in the near future, using cryptocurrency will no longer be something strange or scary. It will become a normal part of the banking app on your phone. You will not need to know about MetaMask wallets, blockchains, or private keys. You just need to open the banking app, select International Transfer, and press Send. Beneath that simple shell, blockchain technology and stablecoins are running, but you do not need to worry. That is the pinnacle of technology, when it becomes invisible and serves human life naturally. But to reach that day, we still have to go through a volatile transition period. Bills need to be passed, systems need to be upgraded, and most importantly, user psychology needs to be prepared. I believe that the participation of US banks with the backing of the FDIC or equivalent mechanisms is the starting gun for this phase. It turns crypto from a risky niche market into a mainstream part of the economy. I tell this story not just to update the news, but so we can reflect together on the ceaseless movement of currency. Money is not just a medium of exchange, it is trust. And this battle for trust is turning a new page, more dramatic and larger in scale than ever before.
Now, after clearly understanding the context and meaning of this story, I want to share with you how we, small individuals in this financial flow, can apply this information to ourselves. This part is very important because knowledge only has power when we know how to use it. First, start observing more closely where you are keeping your digital assets. If you are holding a large amount of stablecoins like USDT or USDC, be aware that although they are very popular, legal risks are always present. When US banks release their coins, regulations may tighten around current coins. I do not advise you to sell everything immediately, but diversify. Do not put all your eggs in one basket, especially if that basket is in the sights of lawmakers. Second, prepare knowledge to catch the new wave. When banks integrate blockchain, many new financial products will be born. For example, savings in digital currency with higher interest rates, or borrowing capital using digital assets as collateral right at the bank. If you understand its operating mechanism right now, you will be the first to take advantage of those incentives and investment opportunities instead of confusedly running after the crowd. Third, be cautious with privacy. As I analyzed, convenience comes with control. If you have transactions that need privacy, carefully consider using digital currencies issued by banks. Understanding the rules of the game clearly will help you protect your personal data better. You need to clearly distinguish which wallet is for daily public spending and which wallet is for hoarding long-term assets. Fourth, and this is for those doing business or investing, this trend shows that large institutions are about to pour into the crypto market in an official way. This could be a sign of a long-term and more sustainable growth cycle. Instead of risky short-term trading, think about investing in infrastructure platforms and technologies that support the connection between banks and blockchain. That is where the big money will flow through. Finally, keep a cool head. During the transition phase, there will be a lot of confusing information. There will be scam projects impersonating banks, impersonating government backing. Always verify information from official sources. Do not listen to promises of sky-high interest rates while forgetting the basic principle. Low risk means profits cannot be suddenly excessively high. Bank safety means stability, not getting rich quick. Thank you for listening to my story today. I hope that through the sharing you have gained a deeper perspective on the future of currency and the position of banks in the digital age. The world is changing every hour, and us sitting here analyzing and learning together is the best way not to be left behind. If you find this information useful and it helps expand your knowledge, please help me share it with friends who are also interested in finance and technology. Don't forget to leave your thoughts. I really want to know your point of view on banks issuing digital currency. Would you choose to trust the banks or remain loyal to decentralized cryptocurrencies? Let's discuss. Goodbye and see you in the next stories.